With the current record seen on Wall Street recently, many are now asking why stocks are doing so well in the current environment. There's going to come a point when it's presumably no longer beneficial to own shares. What is it that's going to trigger that turnaround in the market? Well, Dhaval Joshi joins us now from BCA Research, where he's just published a paper on this very subject. Dhaval, good to talk to you again. Why have stocks, first of all, risen to these recent record highs?
So it's something. It's quite counterintuitive that we're in the worst sort of global pandemic in a century, and yet the sort of aggregate stock market, the world stock market, is reaching an all-time high. So what's really happened is that the pandemic essentially unleashed a massive easing of monetary policy. So bond yields have basically collapsed this year. And that has pushed up the multiples or the valuations of large segments of the equity market at a time when aggregate profits have been falling. But what's happened is that the multiple expansion has outweighed the profit decline. So it's really all about this year's rally, certainly at a global level, is all about multiple expansion. Multiples are expanded by 20%. Profits are down 15%. So net, the market is up 5%. So what this actually means is that the vulnerability of the market is now on valuations rather than profits.
So my understanding then is the fact that basically this is an opportunity for investors to take something that might otherwise not necessarily be have a useful return. In other words, there's no better place in the market for their money at the moment. Is that the simple truth?
That's right. I mean, it's this thing called, as you sort of said, it's like there is no alternative. When the returns on safe fixed income investments like treasury bonds drops down to way below 1%, and if you look at things like Swiss bonds, you're sort of at close to minus 1%. Same with German bonds, you're in negative territory. Then any company that has relatively resilient profits in this environment, in the pandemic environment, will be bid up. That's exactly what you've seen. But it is highly contingent, and I can't stress this enough, it is highly contingent on bond yields staying where they are. If they were to go up slightly, I think that is the big danger. That's the catalyst for a potential shakeout or sort of shuddering of the market.
Okay, let's ask a question then as to what is it that's brought us to this situation. I mean, you and I have been talking about this quantitative easing now for several years. Of course, the market's been preoccupied, I think, since the first QE came in 7 or 8 years ago. And since then, we've seen a lot of money coming in. Subsequent to the pandemic, even more money coming in. Is where we are today because of the hangover from 10, 12 years ago, the great financial crisis? Or is it driven now, more recently, by the reaction to the pandemic?
Well, it's an extension of the same story, because essentially we've had 4 occasions in the last 2 to 3 years where a relatively small rise in bond yields has sent shudders into the stock market. So that happened twice in 2018. It happened once in 2019, and it's happened actually at the beginning of this year. So I'm actually saying that even without the pandemic, the market was quite fragile at the beginning of this year, and we would have had some sort of shakeout irrespective of the pandemic. I mean, the pandemic just accelerated it. So I think it's an extension of the story that we've had for the last few years, whereby it's highly contingent on bond yields remaining ultra low. The moment they sort of creep up, you get to some sort of trigger point, and we're pretty close to one now. We're not there, but we're just highlighting that we're not that far away from it.
Okay, so you're using that then as the trigger point. What is going to spark higher bond yields? Because I think they go then back to the problems that the market has, the fact we've all taken on so much debt. Any increase at all in yields is going to push up the amount of money people are then going to have to pay back in terms of the interest on their assets and on their borrowings rather. That itself is then going to kill any recovery that we've got. it's a difficult balancing situation. When do you see the trigger point starting and the bond yield starting to tick up and staying up?
Well, this is the interesting thing, because the trigger point could be just a little bit more optimism on the economy. The idea that we're coming out of this pandemic world and going back to some sort of level of normality, what that is. And we might, inflation expectations might just sort of rise a little bit, pushing up nominal yields. But I think the actual danger is not from the real economy. I think this is the key point. If bond yields were to rise by, let's say 30 basis points at 0.3%, that's not really going to affect the real economy and our ability to service debt. But where the real danger is you'll get to this sort of tipping point for certain sectors in the market that are riding high. And the risk really comes from a big sell-off in risk assets, not just equities, but if you add up all risk assets, they amount to a huge quantity of money. I mean, I think if we add up stocks, real estate, corporate bonds, we're looking at something like $500 trillion relative to a global economy of 80 trillion. So the risk is not from the real economy, in my opinion. The risk is from elevated valuations of risk assets. And it's not that far away in terms of the amount of bond yield increase that's required to trigger this sort of shockwaves through the market.
In the equity market, sectors do you see as most vulnerable to that point at which we could well see air taken out of the tire?
Yeah, so the most vulnerable segment is technology. And what we've seen actually is there's a remarkably consistent relationship that's applied for the last 3 or 4 years. And that is when the earnings yield on, or the earnings yield on tech relative to the bond yield. So what we're looking at is it's called the earnings yield premium. What's the earnings yield on technology versus the 10-year bond yield in the United States? When it gets down to 2.5%, this tends to be a kind of the lower limit, at which point the market tends to recoil. And this is, as I say, it's happened 4 times at exactly the same level, a 2.5% gap. So obviously, as tech stocks go up in price, the yield, the earnings yield drops, and it gets to this sort of trigger level, as I say, where the gap is around 2.5%, and we're pretty close to that now. We're now at around 2.8%. So what that means is if technology stocks stay where they are in terms of price, and the bond yield goes up by 0.3, then we get to this sort of trigger point again, because we're at 2.8, 2.5 is the trigger, so there's a 0.3% gap right now.
Okay, let's take it from the other end of the market that could well benefit from all this. Let's face it, that when we look at portfolios, many of us have to be in stocks or like to be in stocks. Which are the areas of the market where we're going to see an insulation from this sort of re-rating of those extremely valued stocks? Where would it be best to hide in the stock market, given what you're saying?
Well, just to be clear, if we get a sort of shakeout in the stock market, then nothing really sort of escapes fully, because it's really unusual for stock prices to drop and certain segments to rise at the same time. And generally, things move down. However, once everything settles, you do get some winners and losers. So I would suggest that the winner in this scenario would be, well, one of the winners would be healthcare, because what we've seen, the sort of valuation lift or re-rating of tech has not extended to the same extent to healthcare. So looking at this sort of this thing called the earnings yield premium, in healthcare, it's still looking pretty attractive. So the earnings yield on healthcare versus the bond yield is still a very healthy 4.1%, much higher than for technology. So these are both growth, what are known as growth sectors, but the discrepancy in performance between technology and healthcare over the last 6 months has been pretty extreme. So, tech has outperformed by about 25-30% over the last 6 months versus healthcare, which is very, very unusual. So I would say that on a 6 to 12 month horizon, you might want to rotate from one growth sector, which is tech, to another growth sector, which is healthcare, just because the elastic has got quite stretched between those two sectors.
Lovely. Look, we'll leave it there, but thanks indeed for that, Dhaval. It's an interesting idea and waiting for that trigger point to occur. But thanks for joining us online there. Dhaval Joshi from BCA Research on the trigger point that could well see a turnaround in the markets. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.